Andrew, you say that bonds pretty much got a recession priced in, but equities looking more towards a slow growth story. So which of those two is right?
Well, markets can be wrong for some time. Just think what happens in a bubble or a bust. We think on balance that it's still likely that equities over time will make better progress, that bonds really are priced in a bit too much bad news. But clearly, as you've been talking the last 10 minutes or so, that is going to need some changes to the political outlook, especially between the US and China, but other parts of the world as well. And that's not likely to happen quickly. So range trading for markets, I think, is the order of the day for some time.
Yeah, for equities, is Fed easing and other central bank easing really all they've got at the moment, absent a resolution to the trade war and an environment of slowing global growth? Are you seeing any evidence of this easy money from central banks being put to work productively in terms of capex?
Not on the capital spending side. I don't think that's a great surprise. Sentiment clearly is weak at present because of all of the political issues that are out there. And I think many investors will be waiting for the APAC meeting later this year, and does that cause some changes? I think we are beginning to see some investment being put to work in the sense of moving material out of China and into other countries such as Vietnam. So supply chains are already beginning to respond to this. But I think looking forwards, one of the issues, of course, that we've got to remember is that the US earnings season starts soon. Expectations are for modestly negative growth if it ends up modestly positive. And, of course, the share buybacks will then start to kick in as well. So in between the Fed on the one hand and the politics on the other, I think we will have the earnings news, which we think should provide, well, a floor to the market or perhaps some potential upside, obviously stock by stock, sector by sector, perhaps for the market as a whole.
How about emerging markets? Because we continue to see this hunt for yields now turn to these EMs.
Yes, we do like emerging markets. They're slightly better on valuation grounds than many other parts of the world. And, of course, we are in an environment currently where even if the dollar's creeping a little higher on a sort of trade-weighted basis, by and large, central banks in emerging markets are able to make rate cuts, the Reserve Bank of India the other day. And so emerging market debt is one of our most overweight positions at present. So I think emerging markets generally, yes, rather more selectively perhaps in terms of equities. But yes, it's an attractive part of our portfolio at present.
Not an emerging market, but we have heard those valuation reasons behind JP Morgan and Morgan Stanley favoring Japanese stocks. And yet this GTV chart on the Bloomberg showing that a Bloomberg survey sees analysts seeing more yen outperformance. So how do you measure those two up, and what will this mean for Japanese equities?
Well, we do like Japanese equities again. US emerging and Japanese are our three most favoured markets. And I think the drivers, the fundamental drivers behind Japanese equities are very clear. Some quite good profits growth at present compared with the past, the dividend growth and the corporate governance changes that are taking place. We will wait to see, of course, whether or not the sales tax will crimp that profits in the short term. So it is a favoured part, but we absolutely take the case that the possible yen strength, and it must be said that the yen, together with the Swiss franc, and you mentioned gold earlier, those are classic parts of many investor portfolios now as a safe haven, a diversifier. So on balance, we do like Japanese equities, but it's only a moderate overweight when we do have this possibility always of a yen spike if there is some bad news in the world economy, and on those days investors are rushing back into safe haven assets. So it can't be a very heavy overweight in portfolios.